So why do a lot of people struggle with trading? Well, I can give you a really quick answer, which is that it's very counterintuitive. But there is a longer answer, and that's what I'm going to talk about in this video. Please like and comment on the video below. That will allow me to produce better quality videos and more of them in the future. So let's look at a market. We start with the price over here. You think, well, this price is going to go up, and the price goes up to here, and you make £200 or whatever your target value was. So that's quite simple. Price starts here and it goes there. That's how most people think that the market works. But the reality is completely different. So price starts here. And at this point, you can make a judgment at any point from the open to the close of the market. Now, the curious thing about the way that the market works is the average result in the market tends to be zero. So the distribution of gains and losses tends to center around zero. And that would tend to occur if you're in a market that's producing roughly random returns. So you look at the bell curve, and up here you would see a certain level of return. You'd see a lot of returns around the middle, and then it would sort of tail off a bit towards the end. That's a terrible bell curve, but hopefully you get the idea of what I'm saying. So you would sort of say, well, actually, I think it's going to finish here for any particular reason. And you can, get that with a reasonable degree of certainty, and various other degrees of certainty as well. But the interesting thing is, if you trade at random over a very, very long period of time, you'll get positive results and you'll get negative results, and they'll balance each other out, and you'll end up at zero overall. But of course, you've got to pay a bit of commission, so that detracts from your positive values, and you'll end up net negative overall. But if you trade at random, you'll end up and down in roughly equal amounts. And we're talking in the context of a horse race here, taking a position in the last 10 minutes, closing it at post time. That's how the market behaves. Now, let us say that we're looking for a particular setup. And that's what you should do. You shouldn't go into the market and say, what's the market doing? You should be saying, I think the market's going to do the following for the following reason. So we're looking for a setup where the price is going to drift. There are a number of setups that you can use to do this. So we know that the price is going to go from here to here. We can be pretty certain that that's likely to happen, or on average it's likely to happen. Every now and again we'll get it wrong and it will end up in a loss. Every now and again we'll get it right and it will end up in a positive territory. But of course we'll get it right more times than we get it wrong, and that's where we'll make our profit in trading. However, there are many reasons why you may never see that profit, because the market doesn't actually do what I've said on that previous slide. It doesn't sort of just go like that and heads towards that particular price. That is the path of desire. So we know it's going to end up there for a particular reason. This is the path of desire that's pulling it in that direction. But what actually happens in the market is the market never goes in a straight line. The market will go up, it will go down, it will go up and down, it will test your patience, and then it will finally end up at that particular point. That is the status quo of the market. That is the way that the market tends to work. It doesn't tend to go in one direction. People do things, they change their mind, the market changes their mind, things happen, and it varies all over the place. It wobbles all over the place. So the thing is, if you actually opened a position automatically and closed it automatically using this trade, you'd make a profit. But if you're actually watching the position, at various points within the markets, you would come under pressure. So initially, the market's going in our direction and we think this is great. And then the market turns around and abruptly starts to go against us. So at this point, there's a load of pressure on you in the market to get out. Do you hold your position? Do you have the faith to keep your position, knowing that it's going to end up over here? So when you see me trade, I'm looking over in the other direction. I've got a list of things in my head that basically say what I want to happen. And if all of those things are intact, I will hold my position even if it starts to go against me. But a lot of people can't do that. So let us say that we actually join the market a bit later. Let's say that we actually join the market right here, and our position goes against us immediately. Then the problem that we've got is it looks like it's heading in the direction you cut out, only to see the market move back in the other direction. So this is why trading is hard. People find it very difficult to cope with these little bumps that occur within the market. Your call, your decision that you made in the market may be completely correct, but the fact that the market is moving against you creates a major issue for you, psychologically that is. So let us say that we join the market here, and we're still expecting a little bit of price movement. So we're expecting the price movement, if I draw roughly here, to give us this gain in this area over here. The problem that you have is, on this occasion, it's not where you plunge to a loss immediately, you cut out your position only to see it go back in the other direction. You actually start to make money, but then you fear that you're going to start losing money, so you cut your position there, only to see it turn and go back in the other direction. For a brief period of time, it feels like you made the right decision, because it starts going even more negative, and then it surges back, and then ends up back in this position. So what's actually happening here is the market is shaking you out. The market's wobbling one way and the next, and while your decision is correct, if you traded this completely random, you'd get it right a lot of the time. But if you're actually sitting there watching the money go against you at certain points within the market, you tend to drop your position. You tend to cut out. So the way that I overcome this is I basically say, these are all the reasons that I think that the price is going to go higher. You know, we've got X number of reasons. We've got, 1, 2, 3, 4, 5 reasons that we think that this is going to happen. And I score the trade as I go through. So if there are 5 things that make me believe that this is going to happen, and that suddenly decreases to 3, then the trade isn't so good any longer, and I'll start thinning out my position. If all of the characteristics exhibit themselves strongly all the way through that trade, then it's a great trade. But if my internal scorecard on the trade rises or falls, in other words, I'm not seeing the things that the setup requires, then my confidence in the trade goes down, and I'm likely to exit for a loss, or I'll thin out my trade. If all of them remain intact for a long period of time, then I'll probably increase my trade as the market moves up towards this position. So this meandering in the market, that's typically the way that the market works. And when you look at it from a psychological perspective, there's been loads of studies on this, but basically a loss feels twice as bad as any gain that you get. So the problem is, when you feel like you're about to lose money, it really hurts and it chucks you out of the market. And this is why people find trading hard, because you may have actually made the correct call. You may have been looking at the market here and it ends up here, but somehow you lost money over the course of the trade, simply because the market was shaking you out of that. Now, the unfortunate thing for you about trading on sports markets is that is the natural behaviour of the market. So say, for example, we're looking to back something at odds of 2, and then they move to odds of 3. Now, from a value perspective, obviously getting odds of 3 instead of 2 is a huge tick. So, why would you, if you were looking to back at 2 and you can get odds of 3, you would definitely back at 3. If the odds get shorter and they go down to 1.5, then from a value perspective, that just doesn't work. If you're going to back at odds of 2 and it's now available at 1.5, the bet is not on. But if the price gets bigger, then obviously you would take that bet. So imagine your favourite football team is playing a team from a much lower division, and you can back them at odds of 2, and you're not sure about whether they're value or not. If we replayed that market and gave you odds of 3, you'd almost certainly back them. But if they were much shorter odds, then you probably wouldn't back them. And this is the way that the market works. So if you actually look at the way the odds progress, say we had a starting point of 2, and the odds started to meander all over the place and then start going to odds of 3. The thing is, that will pull in people that are trying to get value. People may have orders above the current price that they're waiting to get filled. But even if they haven't, and the price starts to rise up, what do you think is going to happen? If the odds are getting bigger and bigger and bigger, it's more and more and more likely to attract backers. So in which case, the market will start to head back in the other direction. And the opposite happens in the other direction as well. If the odds are coming in and coming in and coming in and getting to very, very short prices, then it's very likely that layers will step in and start to push the price back in the other direction. Or it could be matched bettors, it could be bookmakers hedging on the exchange, it could be any manner of things. So these bits of activity that you see in the market, the natural order of the market is for the market to move around quite a lot. It doesn't go in a straight line. There's no reason to believe that it should go in a straight line. Sometimes it does, or a slightly bumpy straight line is probably the word I'm looking for. But typically, as the market moves in one direction, it gets good value for one side of the book or the other, for the backers or the layers, and therefore the market will start to head back in the other direction. And whether it's on the one that you're trading or not, that's critical as well. So say again we've got odds of 2 and they drift to odds of 3, they head up in that direction, then if you've got something on the other side of the book, let's assume this is a perfect market and we've got 2 things at odds of 2. If this one moves up to odds of 3, The only way that the market can remain in balance is if the odds on this one come back in the other direction and they go to odds of 1.5. So whatever happens in the market, one outcome will directly affect the other, because that's the way the market's priced. That's what the odds are telling you, the chance of something winning. The odds on something drift, the odds on something else have to come in. So the natural order in the market is that as the price moves up, it will attract backers, and as the price moves down, it will get good value for layers. And therefore, that will cause the market to meander up and down. But also prices are interrelated. So that's going to cause the market to meander as well. So whichever way you look at it, the market is going to meander. So you have to have an opinion when you first arrive in the market about what's going to happen. You have to decide where the bias is within the market. Which direction is it pushing in? It may be a strong bias, it may be a weak bias. But when the price starts to move, it's unlikely to move in a straight line. It's just not going to happen like that. It's very unlikely. What will most likely happen is it will meander around and eventually find a point somewhere near. And sometimes it may not quite reach the point at which it should do for a number of reasons, but it's going to meander on its way to that particular point. So one of the reasons that people find trading so hard is this constantly plays on your mind. You'll take a position, it turns into a loss at some point. This could be pre-play or in play. We're talking typically pre-play here. And as the position goes against you, the temptation to cut your position is incredibly strong, because it's human instinct to fear a loss. But as you travel down this path towards the closing position, it may have been actually better to hold that position in the market for a period of time. So yeah, if you want to know why trading hard, that is why it's hard. If you want to know what to do about it, keep an internal scorecard. Have things changed from the moment you entered the market? Has your opinion changed? What is actually changing within there? You could be unlucky, you may never get to that particular point. But the fact is, if you do it enough, over time you win more than you lose. And that's one of the reasons that trading's hard and what you should do about it.